What's up, guys? Welcome back to the channel. My name is John, and this is John Paul Investing. So just today, Chamath Palihapitiya, or the person who brought Virgin Galactic public and Open Door and also Clover, just announced that IPOE is going to close a reverse merger with the financial tech company SoFi. So just to explain what SoFi is they are a basket financial services company. So they offer a variety of products. They offer things like personal loans, student loans, home loans, refinancing, things of that nature, even personal investing. And another product they actually have that I like is the one that incentivizes healthy spending and good spending habits. They pretty much reward you for paying down your debts, which I think is going to be a positive thing, because nowadays we do live in a instant gratification, high leverage society where, you know, people will spend what they can now and then just take out loans and pay debt for the long term. And I really don't think that's how it should be. So I think SoFi is targeting this issue. So for anyone who follows Chamath Palihapitiya pretty closely, he's very meticulous about how he makes his investing decisions. And I think that if you do want to see some success in investing, you don't have to follow him to a T, but if you apply the fundamentals that Chamath has, it is a very good learning opportunity to have successful investing habits for the long term. So if we go on his Twitter account, we'll see that IPOE is merging with SoFi to take them public. This is an incredible company in banking and FinTech that has a potential for a winner-take-most outcome. So I wanted to bring up the investment thesis for SoFi that Chamath Palihapitiya put on his Twitter account. We were going to look at this in its entirety just so you guys can create your own investment decisions based around the information he's giving us. So in this summary, incumbent banks have been hamstrung out of the great financial crisis. Legacy technology that is, in some cases, 50 to 70 years old, has limited the capability of incumbent banks to thrive in an increasingly digital native world. Meaningful changes to regulatory capital ratios, reduced activity in profitable business areas such as trading, and increased operational oversight have all restricted their growth. Focus on short-term return on equity has driven restrictive lending practices and poor customer experience. Shareholder returns and total market cap of the largest banks have been flat and largely decoupled from rates since December 2013. Innovation is emerging rapidly to disrupt these legacy banking practices. Consumer expectations in financial tech are converging to what consumers already demand in other areas of the economy, driving a consumer migration from legacy products to new startups that offer 1. Low to no fees, 2. Fair and transparent lending, and 3. Multiple products and a one-stop shop for a variety of consumers' financial needs. The qualitative of this summary. SoFi has built a suite of best-in-class digital solutions to help consumers get their money right. SoFi offers a full suite of lending products and financial services to customers, which have driven increasing adoption and sequential quarter-over-quarter growth over the past 6 quarters. SoFi also offers the leading enterprise banking infrastructure platform for other financial tech companies. And now the numbers, or the quantitative. Best-in-class customer acquisition cost and churn allow for the best-in-class contribution margins and rapid growth. What this means is that they have very low acquisition costs, and the churn, or the rate at which people are leaving the business, is very low, allowing for best-in-class contribution margins, or the revenue minus the variable cost that would offset the fixed costs in the company. 65% of home loan sales came from upsells to existing members, and 24% of all new product sales came from the upsells to existing members. So this means that existing members are staying in the business and trying new products within the business. So essentially, this is showing loyalty in SoFi's products, and this is a good thing for the business. Adjusted net revenues are scaling rapidly by a 5-year compound annual growth rate forecasted to be 43% annually. So they had $621 million in revenues just last year, and the expected revenues for this year in 2021 are close to $1 billion. And at the end of 2025, or in around 4 years from now, we're expecting close to $4 billion in revenues, which is up, almost 5 times where we are right now, over 5 times. Forecasted profitability in 2021 with growing adjusted earnings before income tax, depreciation, and amortization margins are approaching 32% by 2025. And the margin of safety for new investors is the enterprise value at $6.58 billion with an equity value of $8.65 billion. And in 2025, they're expecting a very low enterprise value at just 1.8 times the 2025 estimated revenues. Now, of course, the figures beyond last year are, of course, all forward-looking statements. But whenever Chamath Palihapitiya sets out for something, it is very clear that he has a long-term goal in mind. He is not a short-term oriented person. So if you're looking for short-term gains or short-term goals to be met, this is not the company, because this is an emerging sector and we're really not going to see these companies grow into fruition for at least, the next 4 to 5 years. And this goes for a lot of companies in the growth sector right now. It's not just IPOE, this is just in general. I also wanted to bring up one of the products that SoFi offers is the first credit card that can help people pay down debt. They launched a first ever credit card which incentivizes healthy financial habits and delivers on its mission to help people get their money right. It provides up to 2% unlimited cash back when you redeem it with SoFi Money or SoFi Invest accounts, or if you use it to pay down your SoFi student loans or your SoFi personal loans. And if you don't already know, 2% is a very good rate because a majority of credit cards only offer around 1%. Most of the products that they offer this 1 to 2% on is really specific products, and it's not incentivized at all to, pay down your debts. It's really incentivized to go and spend more. So this is the first product that actually incentivizes you to pay down your debt and pay you a small premium in the process. So on the surface, this looks like a really good company. I do think that in the long term, this company will grow. I don't think that you should go super heavy on this company just because I feel like there's a lot of other opportunities to go in. Maybe in the short term, you can get a doubling, but really the multi-bagging that you would want to expect in an investment won't happen for at least, a long period of time. Understand that you're in this company for the long term and you're not trying to day trade this product. Or stock, I should say. But anyways, guys, that is it for this video. I just wanted to bring this company to your attention. If you like stocks or other investing related content, I highly recommend you guys subscribe to the channel. If you liked what you're watching, go ahead and hit that like button. And while you're down there, go ahead and hit that big red subscribe button. And don't forget to hit the bell notification to get notified when I make videos just like this one. That's it, guys. Thank you so much for watching, and I will see you in the next video.